Hello guys, hello. Welcome to this MSISA VIP evening today. We just wanted to have this evening to thank all of the MSISA clients. So you guys definitely deserve a pat on the back, whether it's one or some of you 5 properties that you've purchased. This is definitely a very important milestone, and we just wanted to have this evening here today to say thank you for doing that. I know it's definitely nerve-wracking. I've got a couple under my belt, and I know every single time that you go in there and you have to sign those forms, it can be quite nerve-wracking. So definitely you should be proud of yourself. So today we would like to thank our sponsors. So obviously MSISA Consulting, Sanders. We would also like to thank Link Finance, Jeremy Zabat, and we would also like to thank your future advice, which is Michael Osborne. So our evening today consists of these guys presenting on what they're very passionate about. So whether it's property, finance, or lending, you'll get to hear a little bit about all of that today. We will also serve dinner during the course of the evening. So this is a very good time, so just sit back, relax, take plenty of notes. So just going to start out and present our first presenter today. So Jeremy is about 20 years of finance under his belt. He's the director of Link Finance. No doubt some of you might have dealt with him during your process in purchasing your properties. So he has 20 years experience in banking and finance, and he'll be talking to us today about lending. So everyone, please welcome Jeremy Zabat.
Thanks, Sandra. Thank you, Sandra. Firstly, thank you everyone for attending today. Sanders, thank you very much for giving me the opportunity to speak to everybody. Just a show of hands in the room. Understand most of you guys are existing customers of Sanders. Who here owns an investment property at the moment? Okay, great. It's good. Just because I'm going to be throwing a few questions to the floor and just to get a feel for the knowledge and what I can share with you guys today. So today I'll be presenting on buying property, both inside and outside of super. So what that means is purchasing property in your own names, but also if you get the opportunity to have a look at buying property through super, also how does that work? So to start off with, just a bit about my background. Like Sandra said, I've been in the finance industry for 20 years. In banking and finance, so I've spent some time working in the major banks. We've got our qualifications through with the relevant associations within the mortgage industry. And at the moment, I've got a team of 8 people in our office, and we look after so many different clients, from your self-employed to your investors to your first home buyers. Disclaimer, so what I'm about to talk about today is just general information. So as you know, it's something that we need to disclose at the very start. So if you do have any questions about your personal situation, more than happy to answer that later on. So the topics of my discussion today will be based on the benefits of using a mortgage broker, and also whether it's a bank or a mortgage broker, how that works, boosting your borrowing prospects, unlocking equity to buy an investment property, and SMSF lending. So the first topic, benefits of using a mortgage broker. So in our office, like I said, we've got eight people in our office, 4 of which are mortgage and commercial finance brokers. So we've got about 80 years worth of experience in our office, and we see a lot of different situations every day, from your self-employed client to your first home buyer to your investors, business customers and so forth, and all have different backgrounds and different requirements and situations and have different objectives. So with that, our experience that we bring forward to our clients is one of knowledge of a lot of client situations, how to resolve, provide solutions to those customers and achieve the outcome that they're after. Now with that as well, with our experience lending advice and structuring, like I said before, whether it's a first home buyer or an investor with 1 or multiple properties, that's where we provide value. And in our industry at the moment, you probably see some statistics there that 60% of new loans that come into the market are driven by the mortgage broking industry rather than going through the major banks. And with our industry as well, we were governed by a best interest duty, which has come about this year in 2021. Where that differs with the bank is that the banks don't have that requirement, so they've got one product, whereas with us we've got over 20 lenders. So when we do look at a client situation, we assess the customer's situation, understand what the requirements are, and then review a large range of lenders before we present that to our customers for the best interest, just to make sure that everything that we're presenting, they can make a well-informed decision before they move forward. So we manage application from start to finish, and also we've been lucky enough to be nominated for a few customer service awards over the last few years. So that's just a bit about us, and in regards to our next topic, boosting your borrowing prospects. So this has been a very popular topic, and this is a very common discussion we have with a lot of customers. They say, Jeremy, what's the best way of getting a loan approved? And there's no right or wrong answer. It really depends on their situation, like I said, but also what their objectives are. If it's to buy 2 or 3 investment properties in the future, how do we set that plan in place? What equity or assets do you have? What savings do you have? And what's the plan going forward? So a first start is demonstrating good savings history or equity. So as you know, when you buy a property, you need to have some savings or equity in another property to help achieve the minimum contribution you need to buy a property. Whether it's an owner-occupier, like I said, from a first-home buyer looking at property, you need to have at least 5%. There are some lenders out there now looking at a lower deposit. You would have heard recently in the budget, during the week, the government announced a 2% deposit for single parents with dependents, which is great because a large challenge that a lot of those people have is not having enough deposit to buy a property. So generally speaking though, when you're an owner-occupier, it's 5%. When you're an investor, it's usually around 10%. So if you do have that deposit, you do have a few other costs such as stamp duty and so forth that you need to consider, and then there's mortgage insurance to get into a property. But we can, with anyone that needs more advice there, we can talk about that in more detail. Credit score is also very important. So as you know, with any applications that you submit for a store credit card, to a personal loan, to a car loan or a home loan, you get marked on your credit file. So it also looks at your account conduct now, so comprehensive credit reporting, as well as your repayment. Okay, so making sure that you make your loan repayments on time, or any personal loans or car loans, or even utility bills to an extent. Making sure that your credit conduct is clean goes a long way when you're applying for finance, because now the banks look at a comprehensive credit score, which sort of marks you as one of the criteria when they assess customers. Also, when we review our customers to boost up the borrowing prospects or borrowing capacity, everyone wants to know what the borrowing capacity is. Reduce unnecessary debt. So when we do review a customer, we'll look at existing loans and whether there's capacity to reduce some of those limits that are unused, whether it's needed or not. That's another key part when you're looking at your situation. Living expenses is a very popular topic, because that's something that's sort of come about in our industry the last 2 or 3 years. Ensuring we ask our customers about what your living expenses are, also checking the bank statements to see what the living expenses are. A lot of the banks out there would look at your last 3 months statements, for example, and look at your expenses. Some lenders would actually, some lenders in the market have a team that actually looks at your living expenses before it goes to the credit department. So that's something to consider when you're applying for a loan. If there's some unnecessary spending, just try to rein it in before you prepare for your loan purchase or before you prepare for your application. But again, if you do have more questions on that, just let me know, and we can talk about different strategies and methods to ensure your living expenses are within the bank's consideration. Employment and income capacity is vital. So from my perspective, income capacity is the most important aspect. The reason why is because it's what drives your borrowing capacity and basically outlines what you can and can't do. So employment, just a rule of thumb, if you are employed in an industry and you move jobs, this is another common question that I receive, will the banks consider my income? The short answer is yes, if you're working in the same industry for 2 years. If you've been working in the same industry for 2 years, they can include your income from day one. If you have changed industries, for example, you're a nurse and then you decide to become a courier driver or a mechanic for whatever reason, then they won't accept your income after you've demonstrated 6 months worth of employment. Okay, so that's something to know. I get that question quite a bit. And just making sure all your paperwork is in order. So generally speaking, when we see a customer, we like to put together a list of information that we need. There's generally about 6 or 7 items that we need to review before we can sort of take it the next step. So we do a pre-assessment, check all information, and then organise a meeting with the client and work out the borrowing capacity and so forth. So information that customers would need to provide is obviously the IDs, income documents, any savings, any loan statements as well. Okay, the next topic, unlocking equity to buy an investment property. Okay, so all of you guys, if you have purchased an investment property before, you might have come across this process dealing with your broker or your bank. So unlocking equity is a key part, and obviously we've had a bit of growth in the market recently. So whoever owns property at the moment might have experienced some equity that they never had before and may consider tapping into that equity to buy another property. So equity in short form is essentially the market value of your property versus whatever you owe against that property, the debt. Simple equation there. What you can actually use from a bank perspective is not so much that, it's basically up to 80% of that value. So generally speaking, if you want to avoid the whole lender's mortgage insurance, if you had a property worth $1 million, you owed 600,000, you typically can borrow up to 800. So you've got 200,000 worth of equity that you could use for another deposit to another property. That's not the maximum. You can actually go up higher to 900,000 if you want to, but that's when you start paying a bit of mortgage insurance. So as I said before, equity is essentially the difference between the market value and your debt. And here's a simple example of a client that would have purchased a property in 2016. So just to demonstrate what I spoke about before, if they purchased a property for about $650 and they applied for a 90% loan at $585, let's say in a few years later on it's worth $850, then that loan that they had originally for $585, assuming it was interest only, they haven't paid it down, it's now at a 68% LVR. LVR meaning loan to value ratio. It's one of the key ratios that we look at when we assess a loan. Now, given that loan amount's $585 and they're looking to utilise their equity, when they say, I want to leverage my equity, it's essentially looking at what is the 80% or 90% maximum against $850, and it's $765 over here. So at $765 minus what they currently owe, there's $180,000 available in equity release. So typically when we structure a loan, we would look at this situation and say, okay, how much equity do we have available for us to purchase your next property? And in this scenario here, there's $180,000 available to go towards a 20% or a 10% deposit, depending on what your budget is and depending on your tolerance of paying lender's mortgage insurance or not. So that's a typical scenario of an equity release. Okay, just moving to the next topic. Are we asking questions now or towards the end once I finish? Okay, sure. So self-managed super fund lending. This is a very popular topic. I find as a broker, I've been a broker for 15 years, but in banking and finance over 20 years. So as a broker dealing with mum and dads, I find that the typical scenario would be purchase a first home, purchase an investment property, and the second property might be a super fund. So I see that quite a lot. I also see customers that haven't bought a property, wants to jump into the market, would buy a property through SMSF if they've got enough balance. So there's different ways to take advantage of this, but it's a very popular area, and we get a lot of questions about can we buy property through super? How does it work? Do I have enough super? Will I qualify for a loan in super as well? So superannuation being regulated, it's very important to make sure you seek financial advice. Okay, so that's the first thing, to see whether you qualify, whether it's a structure that suits yourself. But get the financial advice. Next step is speak to a finance broker, because you want to know what your borrowing capacity is within super, and whether you pre-qualify for a loan approval. And then obviously when you find a property, make sure it fits within your budget for SMSF lending. So SMSF lending is basically, like I said, it's been in the industry. It's been in the industry for a while. So typically before, people weren't able to borrow in super. They needed to have enough cash in super to buy a property. But in 2007, I believe they allowed what they called limited recourse borrowing, which means you can borrow against your super fund to buy an asset or a property. So typically the property being an investment, there are certain criteria that you need to meet, but one of the major drivers of customers looking at buying property through super is the tax benefits. Okay, so the tax benefits, which you can speak to your accountant and your financial advisor about, but generally speaking, I believe it's 10% capital gains tax. That's one of the biggest difference versus buying a property in your own personal name, where your capital gains tax is a lot higher if you do sell that asset. There are also some tax benefits during retirement too. But again, speak to your financial advisor to understand the advantages and disadvantages of buying a property through super. So in terms of what, my next slide is going to cover a bit more in terms of the structure of an SMSF loan. But I'll go into that next. Sorry. The last point, serviceability. Customers ask, how does the loan assess the super fund when it borrows? So what the lender will look at is typically the super contributions that you're receiving by your employer, or whether you're making contributions yourself. So for a borrowing capacity assessment, we'll be looking at what income is the super fund receiving currently, or what it's going to receive going forward. So if you're earning about 100,000 per year, for example, your super contributions is 9.5%, being 9,500. We'll look at that as an income, plus the rental income from your property that you're purchasing. So when we add those two together, we calculate borrowing capacity on those two figures, and obviously look at your current balance to see how much you need to purchase a property. So like I said before, some of the criteria or minimum criteria that the banks will look at before they approve a loan is how much do you have in super. So typically if you've been working together, if you've been working in the industry or whatever job you're working in for at least 10 to 15 years, you find that your super balance would be close to around the 150 mark. Obviously, if you're a couple, it might be higher because you can combine them together to create your own super fund for your family. So the minimum starting balance that a lot of the banks would like to see is between 150 to 250. The ATO guideline is 200,000. That's usually the starting point. But if you're sitting on 150, there's strategies or plans and goals in place where you can aggressively increase your super balance in the next 12 months to get you to a 200,000 minimum. So that's usually the range that a lot of the lenders would like to see. The maximum loan to value ratio, so I said LVR before, loan to value ratio, is usually 80%. So when it was first released, it was 80%, then we saw that come down to 70%. Now it's come back up to 80%. There are lenders out there that can lend up to 80%. And that's both residential and commercial lending as well. Liquidity ratio is another key requirement that we need to look at when assessing an SMSF loan. It's essentially the minimum funds held after settlement. So what that means is if you purchase a property of say 500,000, some lenders out there would say, okay, we want a 5% liquidity ratio. What that essentially means is 5% of your remaining super balance left in your account, so 5% of the asset value, say 25,000 if it was a 500,000 purchase, is to be left after the transaction is completed. And the reason why they say that's because if you purchase a property, they don't want to see customers essentially put all the money in super into a property. They want to have some money left over to cover ongoing costs, administration fees. In the event that you've got no tenant, or in the event that you're not working, you've got some money left over called liquidity. So that's something that the lenders tend to look at. Construction loans as well is not available through SMSF, so you can't buy a block of land and build a house under two separate contracts to build a new house under super. But there are ways around that. So if you purchase off the plan, that's usually okay. If you sign a contract for 10% and you pay 90% on completion, provided you are not the ones doing construction, that's acceptable through super. Okay, so we've seen customers put a $10,000 deposit and pay the balance on completion, or put 10%, whatever the case might be. Those scenarios could work, but not a construction loan. The other key point with SMSF is you cannot leverage against the existing equity from that property. So if you had a property worth, say, 800,000 and you only borrowed 400,000, there's 400,000 worth of equity there, you cannot reapply to the bank to say, hey, can I increase that loan up to 600,000 to pull money out to buy another property? So that's another restriction with SMSF, but there's also other ways that you can work around that, and a common scenario would be to have an offset account against your super fund loan, because the offset account, you essentially not reduce, while you increase the balance in your offset account and you put more money towards that, and you accumulate your savings through the offset, it doesn't necessarily mean that you are paying down the debt. So you can re-leverage that money from the offset, or whether you sell the asset. So if you sell the asset, it's worth 800,000, you owe 400, you want to buy another property or buy another two properties, you sell the asset, you've got 400,000 in your account, you then use that for a deposit for another one or two properties. Okay, so there's other ways you can get around that. And like I said before, it's important to get financial advice and legal advice. I think financial advice needs to happen at the start, just to make sure it's suitable for you and get the right strategy, because there's numerous ways of growing your wealth for retirement through super. So it's important to understand what all your options are. Okay, just running through a quick case study. So we had a customer last year that purchased a property up towards Newcastle in Thornton, a 3-bedroom townhouse for 420. So how this played out in terms of the structure, basically when they combined the money in super, they had about 314,000 in a joint balance, and they borrowed up to 70% towards purchasing that property. So they utilised about 150,000 to cover the deposit plus stamp duty, legals and bank fees and setup costs to set up the SMSF. So they borrowed a 294, which was a principal and interest loan at 584. So one thing to note that with SMSF loans, it's deemed as a commercial transaction, so the interest rates are higher than a personal home loan. So a personal home loan and a personal investment loans, you'd be looking around the investment loan, if it's interest only, low threes, but if it's SMSF, it's in the high fours to high fives, generally speaking. So this customer borrowed 294, the repayments were 1733 per month, the rent was 420 per week. So you can see the structure with SMSF, it's usually a set and forget structure, whereby the customer's rent and the super contributions should exceed the repayments and the ongoing costs of that asset. So just by the rent alone would cover the repayments, plus the contributions from the employer would cover any other expenses such as your council rates and so forth, plus accumulate more savings in the super fund. Anyway, after this transaction, there's still 164,000 left, and I believe the customer is looking at buying possibly another property. So that's just a recent case study. And that's basically my presentation for today. If you do have any questions, let me know. But on our website, we've got a lot of information on SMSF and buying property as well, or boosting your prospects to buy property. So if you want to jump on our website, we've got some short videos on what is an SMSF, how do you borrow through SMSF, how do you boost up your borrowing prospects and so forth. So if anyone has any questions, happy to answer that now. If you also want to ask me any questions privately, more than happy to have a chat to you guys over the phone too.
Thank you. That's
Yeah.
good. So if I have an asset now, so I want to transfer to super, I've got it now, so how hard is that transferring to super?
Transferring existing property to super?
Existing property. Yeah.
Yeah, I understand that you can't transfer existing property to super unless it's business property or business real property they call it. If it's a residential property, I believe that's not allowed.
But business you can.
But if it's a business property, if it's a commercial property,
Yeah.
I've seen scenarios where, for example, you had an accountant in an office upstairs, which is owned in his personal name, and he wanted to move that to super. I've seen transactions like that happen.
So
Um,
you have to stamp duty and all this thing there, or?
I'm not too sure about that part, but I know that transaction can be completed as long as it's business real property. So, but I think Michael, our financial advisor, might be able to answer some of those questions.
Yeah, I think around the stamp duty, I think it's going to be a stamp duty trigger because a transfer of title is going from one entity being the individual in their name to the SMSF, which is not the same as the individual.
Yeah.
It's a separate entity. So as far as the Office of State Revenue is concerned, they're going to take your money for stamp duty.
Yeah, it's a good question though, because we get that quite a bit. Because we've got a lot of customers with investment properties and they're looking to transfer into super for tax planning requirements. Unfortunately, there's restrictions if it's a residential property, but if it's a business real asset or business real property, that's what they call it. Being commercial property, then you can.
But stamp duty, that's all.
Yeah, I've seen one where a hairdresser converted the primary home into a hairdressing saloon, the garage. And they moved out, and that was essentially used as business property, and they transferred that into super. It was previously residential, but they converted to a commercial. Yeah.
I've got 3 more questions.
Yes.
Just a question around the MSISA property.
Yes.
If you decide, if you had to sell it, let's say you want to sell it for whether it
Whatever purpose. Yeah.
gain profit or you want to close down the super fund.
Yeah.
How do you go about it?
If you wanted to sell the property, obviously you sell the property through a normal real estate agent, and I've seen transactions where clients wanted to buy another property, didn't quite have enough money in super balance. They already own a property in super. They've sold that asset, they've cashed up with a profit, and they've used that profit to buy another 2 properties. I've seen that scenario. But your question is about closing up the super fund?
I mean, both. Let's say you want to sell and buy more still in the super.
Yep.
So you can do it.
You can do that too. So, like I said, you can sell the asset, cash in the profit, and use that towards buying 1 or 2 more other properties. Because sometimes you buy a property and that market has sort of slowed down. It might have grown then slowed down, and you think, I want to buy a better performing property. I've seen scenarios like that. I've also seen scenarios where clients, in the previous example, they've got a lot of surplus coming through every month because the rent has covered more than the repayments. The super contributions by the employer is quite a lot, so they're accumulating pretty quickly. So they've used that savings to buy another property as well. The only restriction you have with super fund lending is that you can't re-leverage like you can do with a normal house or a normal loan outside super. So I've seen people have strategies where they wanted to accumulate really quickly and buy a property within 2 years' time to buy another asset. So there's no right or wrong answers. I've also seen other customers too use the extra money to invest in shares and managed funds, and if that grows as well, then they've cashed in that and then use that to buy another property as well. So that's why I said it's important to speak to your financial advisor, because there's different strategies that you can look at. If you say I want to buy 2 or 3 properties in super, then you try to plot how you want to achieve that.
Yeah. On that question, so what is the capital gain tax on that
If you sell,
Yeah.
so in that example, if you were to sell that asset, I believe it's 10% capital gains tax. Yeah. Whereas if you sell in your personal name, if you own the property for more than 12 months,
Yeah.
it's usually at 50% capital gains tax. In super, it's 10%, correct? Yeah. And if you were to sell that property during retirement, there's no capital gains tax, right, Michael?
It's exempt.
It's exempt. Yeah.
Pension drawdown age.
Yeah. So there's great tax benefits to buy property through super. That's why we see a lot of inquiries at the moment.
I've got a few other questions.
Yeah, sure.
Now, if you have a mortgage with one bank and you want to get a loan from another bank and use that equity, can you, what's the...
You can use that as well. You can do that too.
Right?
So you can basically borrow up to 80 or 90% against that existing property with Bank A,
Yeah.
and then draw that money out and buy a property and fund it through Bank B. There's no problems doing that as well. So in that scenario, we tend to review the customer's situation to make sure the loan that they have with Bank A is still competitive.
Yeah.
And if it is, that's great. If it's not, then we would normally recommend just put it together with another lender so we can get a better rate on. Sometimes with banks, if you've got more lending, they tend to discount more. So if we can get a better rate on that first loan with another lender, with Bank B, we'd also put that recommendation on the table. Ultimately, it's a customer's choice, but we would look at that different scenario and to say, is it in your best interest, and are you financial benefit? Is there a financial benefit to move your loan across to another lender? Yeah. Any other questions? Yeah.
Give me a scenario where, say, maybe if I've had, say, maybe 3 properties, I don't know, I mean, how many properties you have before, maybe you can have an advantage of living in one of the properties.
Yes.
So does that happen with super fund?
Or to live in the property. So if you buy a property through super as an investment property and then decide to move into the property later on, after a year or two, I don't believe that's allowed. There are restrictions when you buy residential property through super. I understand, and Michael can confirm this, that there are certain requirements and a sole purpose test, they call it, where you need to meet. It's basically when you buy a property through super, you need to ensure that the goals and objectives of that super fund is to increase its asset and value for retirement. So if you move into the property, I think there's a conflict there, right? It doesn't.
Well, it's barred altogether because you can't have any personal benefit of living in the property if it's owned by the super fund. So if the super fund owns the property,
You cannot reside in that property.
You can't reside in that property. Neither you, as the member of the fund, and for that same matter, any of your relatives or either. So there's got to be full arm's length in terms of the investment.
Yeah, no worries. So this is where the financial advice is very important at the start. So you understand what your restrictions are and or what are the options. Any questions? Any other questions? Sanders, any questions? No? All right, great. Thanks very much for your time, everyone. And if you do have any questions afterwards, I'm more than happy to answer it. Thank you.
Okay, so now we're going to hear from one of our clients. This is Dr. Atula Gunasekera. He's doing some incredible things with MSISA Property. So we'll get to hear from Atula today on his journey, his experience on purchasing investment property.
Thank you.
Sorry. I hope to have this microphone on you. I'm gonna put this, sorry, through the jacket.
Must need this or not?
Yeah, you will need it. It's for the public and this one is for a video. Just. Thank you. Perfect. Thanks.
Thank you, Sanders, for inviting me. Where do we start? I think I knew Sanders for about 8 months now. Is that right, Sanders?
Yeah, pretty much.
8 months. So this man. So I was thinking of investing in property for many years. You know, I talked to many people and I had so many meetings. And scary thing, right? So when you see people for the first time and they're going to sell you, promise you the world and say, do this, and then are you going to put your money in them? You know, so how do you trust them? What do you do? You know? I had a lot of people I met before, and so issue for me was that, you know, I had to put a lot of money up front, like 2 or 3 million, right? So to start a project, I had few people came and talked to me, property developers, big project developers, and they wanted, you know, they say, okay, we'll do a deal and I'll manage your project, and you had to come up with 5 million. So I don't know, I was thinking I'll talk to my accountant, Manu, and Manu is my accountant, and I'm not sure where you guys are with him, but through him I came to know Sanders, and so Manu, my accountant, said, look, talk to Sanders, so what do you think about this? So that's how we came about, so then I later found out he worked in the hospital too, Norway's hospital. So my journey with Sanders, so I was really not willing to go this path because I see a lot of uncertainties, and because I'm time poor, so I can't manage things myself. So what Sanders did for me, and I had a couple of meetings with him and said, look, Sanders, what do you think? And he said, look, no, we'll start small. I think that was a good beginning for me. So I don't want to commit to big things. I don't want to, promise. Can't give, 4 or 5 millions upfront or doing things. So I said, Sanders, we'll start something little. Okay. So he came up with a few ideas, and so I said, look, why don't we look at areas where there's a need, and your investment cost is not as much. So what we do is he would look for a piece of land for me with a house there, so we can, while we get the project going, we get an income as well. So there's a investment, so rental, so we get rental income until we get the project going. So this is one of the projects. This is our second one, right? This is he bought me, first one was a piece of land he bought me in Shell Harbour area, and said, look, that's a good deal, and that estate's almost sold out, so I got the last piece, so that's good. So he does all the legwork, he went and look around and tell me, okay, we have to buy this, we have to buy it tomorrow, okay, so he comes to me and say, okay, I'll put a 0.25 deposit, if not, tomorrow it's gone, no, all right, that's fine. How do I trust you, what's going to happen? No, I'll do it, okay. Like that, so I think he's passionate about what he does, and most important, he's knowledgeable, so I trusted him on that. I said, look, that's fine, we'll do it, I'll put a small deposit, 0.25%, that's fine. Then he go and negotiate it and bring the price down by about $5,000 from the original price. So then we bought it, and he went and found a builder, and we had a meeting with the builder. He's a pleasant man, and we started doing the project. So that went great. Then he came back to me, there's another one. Do you want this? I just want a deposit tomorrow. Can you do it? Then, this is my second one. I got another one happening. So this one came about, but I think about a month or two after the first one. I think, should I invest in another one? So I was so happy with how everything went. What he does, what I like about him is that he's very methodical. He'll tell you if he's a project you should do. He said, no, don't touch it. So he's not telling you something to get his commission or whatever it is. Sanders is not like that. So I appreciate that he's honest upfront and tell you, okay, this is a good project, this is what you're going to make. So he come up with this FISO thing, and we sit down and go through the numbers. I go through it, he goes through it, and we do this chop and changes, and we do a feasibility study up front, and we know exactly what you're going to get in the end. So if it's reasonable, if you can make about 20% in the end net profit, so I said, look, that's good, that's a great deal. So this one came about through his perseverance, and I agreed to this. So this is a plot of land, and I bought it for about 620,000 in Albion Park Rail, and there's existing house in there, so we are renting it out. It's enough to cover the mortgage on this. So now we got a plan for 5 townhouses for this place, and we're getting it. We done the DA. We're submitting next week, right, Sanders? Next week, sir? Yeah, submitted. Yeah, also good. Okay. It's all been submitted, and hopefully we'll get through things. So Sanders is very good getting through these things, so I don't have to do anything. So I just he tell me, send me email, I'm sending this, are you happy with it? That's it, So he takes a lot of burden away from me. So as a professional, I got other commitments, so I can't do this. This is my side thing, So having someone like Sanders who I can trust and who can do these things for me is great. So what I see, to me, he's quite knowledgeable in what he. I asked a lot of questions from him. Say, Sanders, what about this? What are the problems we're going to encounter in this place? And have you done all the survey? Have you done this, done that? He come up with it. So he's quite knowledgeable, and he knows the trade, and he's been there doing this for a while. So So I think I have benefited from his knowledge and his experience, and I hope you guys have a good journey with him. You know, if you have any question regarding what I've done with Sanders, you're most welcome to ask me. By the way, he hasn't given me a commission for this, okay? All right?
Any questions?
Thank you.
Okay, so our next presenter has over 36 years in finance.
Oh, yeah,
This
take
guy
it.
has a very good relationship with MSISA Property. He's not only passionate about helping people obviously invest and get property investment, but he's also very passionate about how they protect those assets as well. So please welcome Michael Osborne.
Thanks, Sandra.
Sorry.
Thank you. Thanks, Sandra, and all the microphone for modern technology. Good afternoon, or I should say maybe even early good evening to everyone. Thanks very much for coming today. As Sandra pointed out, I do have a little bit of experience in the finance industry. That's because I'm older. 36 years is a long time. I've had various roles. I'm going to do a presentation on my area of expertise, which is self-managed super funds. And I'm doing it primarily because there's a growing interest in this area, and I'm a financial planner, and so I'm well versed to be able to provide people with the information that they need to go through this process. Okay, similar to Jeremy earlier, we are required to provide a disclaimer, and in short, what it really means for you is I'm not up here presenting information that is about you personally. So this is not personal financial advice for you. It is general advice in nature. And if anything that I present today is of interest to you, the concept is that you would book an appointment to come and see me for personal financial advice, or another financial planner for that matter. What I want to talk about with you briefly is a number of the reasons why clients of MSISA Property are looking at self-managed super funds. Many people, when they look at their superannuation today, and it's a growing area for people as we move from the 9.5% superannuation guarantee area shortly to be 10% from the 1st of July, people really don't know a lot about their existing superannuation fund, I find, in my experience. And when they do have a close look at their superannuation fund, what they realise is that a significant proportion of their investments are invested in shares. Now, for many of us, if I can talk about the typical mums and dads, out there in Australia, which is most of us, including me, a lot of us don't know a lot about shares. And so there's a level of discomfort. And so one of the things that's very exciting about self-managed super funds is that you have the opportunity to diversify and acquire investment property, whether it's residential or commercial. And that gives people a lot of scope. Another thing that's really powerful is that you can borrow inside a self-managed super fund. So if I was to say to you now that if you happen to be in an industry fund like Hester or Australian Super or Host Plus, you can't ring up that fund and say, look, I'd like to borrow $350,000 so I can buy a residential investment property with Sanders. It just is not allowed. But in a self-managed super fund, as pointed out earlier, since 2007, you can. And the power of that simply is this. When you borrow money at 4.7%, which is approximately the typical residential lending rate in an SMSF right now, and you invest that into a residential property that's going to return somewhere around 9.5% to 12%, you're going to be making a lot of additional money on the bank's money. So if you only have to pay the bank back 4.7% and you're making 10%, it's a good place to be, right? And that's the power of leverage. Taking control. Again, people aren't comfortable with shares. When you have a self-managed super fund, you can do a number of things that are quite different to a typical industry fund or retail fund. Yes, you can buy residential property, you can buy commercial property, but you may very well, as the trustee of your self-managed super fund, turn around and make a decision at some point to say, Michael, I'm really worried about global markets, and I think it's about time that we invested in direct gold. Now, I'm not suggesting that you go and invest in direct gold. What I'm saying to you is that if you are a self-managed super fund, you can invest in direct gold. You can buy gold, you can buy fine art, you can buy antique cars, you can buy specialised assets. You have the power as the trustee. There are limitations, but I think the point I'm trying to make is there's a lot more flexibility. The other thing that's really exciting is that you also can join forces. Now, this is more common with, if I could say, a husband-wife, or two partners, or sometimes I find two siblings join together, and they put their superannuation together, and suddenly they don't have $100,000 in super, they've got $200,000 in super. So the opportunity to join forces allows people to set up a self-managed super fund. Okay? You can go up to 4 members currently, and the current government has plans to increase that to 6, although I don't believe that's passed legislation yet. Ultimately, what's the broad aim here? It's to boost your super savings. It's to boost your super savings. And I'm very familiar with some of the MSISA property clients. I sit down with those clients and we explain approximately what their existing industry funds have done in the past and what we expect their industry funds to do in the future and what's going to be different for a self-managed super fund. And the opportunities and the different type of returns you can make are very, very exciting indeed. I've touched on some of the differences between a self-managed super fund and a typical industry retail fund. But just to highlight, the real opportunity is the flexibility to be able to borrow money, to invest the money in areas that you were unable to do in your typical fund, the broader diversification scope, and the opportunity for potentially much greater returns.
Sorry, the previous thing we discussed that you can't have residential
You can hold a residential investment property in SMSF. You can't personally live in the residential property. Right, so
existing one that you own into SMSF.
But if you hold residential properties for rental purposes.
Correct.
absolutely, yeah. So I think that's the point I make, that currently if you don't have a self-managed super fund, you'll be rolling along, sitting in Hester or Colonial First State, and there'll be a board of trustees, and more typically they're going to be making decisions as to where your retirement savings is invested. Now, some people are fairly comfortable with that, but for most of us, once we start seeing our superannuation build up, it gets to a point where people say, I'm not as comfortable anymore. I'd rather take control. And the good thing about the government of today is that they actually allow you to do that. So how does an SMSF work? I've got a couple of very straightforward illustrations. And they're straightforward because if it was complicated, I'd have trouble. I mean, a financial planner at the end of the day, we're also human beings. It needs to be straightforward for us to understand how it works. I've got the typical member here of Hester, and it just by chance happens to be that their partner is a member of BT Super. They come together and they make a decision to join forces. And they set up their own self-managed super funds. 200,000, 250,000, maybe 300,000. And what they then do is they make a decision to A, purchase an investment property, but just as importantly as purchasing an investment property, which I tend to find is people's primary focus, it's also important to understand that there is actually two pieces to the jigsaw puzzle. Because once you purchase the investment property, there's generally going to be liquidity left over. In other words, a cash amount that's not used in the deposit for the investment property. And for many clients, that'll be around $50,000 to $100,000. And it's really important that you have a strategy for the remaining cash as well, because the remaining cash is going to have ongoing contributions come in, and possibly some salary sacrifice contributions on top of the employee contributions. And there's now going to be rental income coming in from the investment property, and there's going to be investment earnings from the investments. So the strategy for what I call B in the fund, the investment, the cash, is just as important as the residential or commercial investment property. And that's where, as a financial planner, we work with clients to maximise both A and B inside the self-managed super fund. Everybody's comfortable with that as a picture? That's as complicated as the general picture is. Self-managed super fund, usually we leave Hester behind, usually we leave BT behind, and it all operates in the self-managed super fund. Your employer will pay contributions into the self-managed super fund once we go through the process. Questions now or later, Sandra? Just later? Yeah, is that all right? Atul? Thank you. An illustration. Like the general advice disclaimer earlier, I do want to say that it's really important that you don't look at this slide on the screen and go, 28% increase by having a self-managed super fund over my existing super fund. Wow, that's exciting. Who in the room would like to have 28% more in their superannuation fund when they retire? Anybody? Hopefully the whole room, right? And I'm talking about 28% more than what you would otherwise have saved if you just stay in your existing fund. So this illustration is a husband-wife. They came together with around about $300,000 or just over in superannuation, and it's a 25-year projection. And what we've done is we've factored in all of the assumptions and variables into the scenario. So if they continued on in their standard existing super funds, what they're going to find, they're going to do okay. In fact, their existing super fund will say, your projection currently is going to suggest that you're going to have a reasonably comfortable retirement. I've seen that on some of the statements. But who wants a reasonably comfortable retirement? Most of us really want to be able to say, I'd like to have a really nice retirement, or maybe even a retirement that's luxurious, or at least better than average. And so the difference here is a 28% lift over that 25 years. And that's one SMSF, one purchase of one property. It may be different for you if it's not a 25-year timeline, but I can work with clients to explain what your numbers are going to be. Let me just very briefly talk about the structure of the way in which an existing super fund works and a self-managed super fund. Because there's a lot of people out there, they come to me and they say, oh, I've heard a lot about self-managed super funds and I think they're very complex and there's a lot of extra work involved. Let me tell you, it doesn't have to be that way. And for clients that work with us, I'd like to hope, especially those that are in the room, that they'll actually testify that working with us it's actually fairly easy. So your existing fund, there is a company called a corporate trustee company on the right-hand side of screen there, or your left-hand side, I should say. And that corporate trustee, in the case of, say, Hester or BT, Host Plus or Colonial First State, that will be a board of trustees chosen by some other body, and there'll be employed advisors that give them advice, and that's how to run the fund. From your perspective as a member of one of these funds, you won't really know that the corporate trustee is sitting there. All you will know is that you're a member of Hester, or you're a member of Host Plus, or you're a member of BT, and that's the super fund down the bottom there. So for all intent and purposes, most people don't think about, oh, there's a corporate trustee sitting above my Hester, but that's how it operates. It operates in that structure in every public offer fund in Australia, which is all industry and retail funds. Now here's the strange thing. When you set up a self-managed super fund, everybody thinks that suddenly it's a really different looking animal, but it's not. It's identical. We set up a corporate trustee company and we set up a super fund. And the only real difference between the two is A, there isn't a board of trustees elected by people you don't know. You become the director trustee of the corporate trustee company. And then the super fund, you can call that whatever you please. You can use your family surname, you can use the initials of your names and your kids' names, you can make up, there could be a term of endearment that you're quite attached to in your family. It's up to you. You can call that the Osborne Super Fund in using my surname, although I'd suggest you don't use that for your super fund. A couple of differences. When you buy property inside super, when you are borrowing money, the government requires you to set up a second layer of entities. And for all intent and purposes, all I want you to remember is the bottom right-hand side here, the Bear Trust. Everybody can see the Bear Trust? All right. The Bear Trust is required when you are borrowing money as part of the whole lending structure, because the government wants to make sure that the bank doesn't have any legal access to the remaining liquid funds in your super fund. So if you think about the left-hand side there, under the SMSF, the super fund, in this case, your super fund, because you've now moved from your industry fund into the SMSF, once that property's purchased and there's $50,000 left over, the government doesn't want the bank to have access to that $50,000 and the ongoing contributions and rental income and the growth of that asset. So if you think back to the previous illustration where I had A, investment property, and B, investments, the government doesn't want the bank to have access to the investments. So if something goes terribly wrong, God forbid, the bank only has access to the property. They can't come back to the super fund and say, we couldn't sell that property for the amount that's still owing, so therefore there's a level of protection that's built into the structure. As confusing as that may be, for all intent and purposes, once you set up a self-managed super fund, you rarely think about those 4 blue boxes. You really only think about the name of your fund, the Osborne Super Fund or whatever it is that you call it. And that's day to day what it becomes. Those structures are in place for a reason, and the only reason I've illustrated that on screen is just so you can have a look at how it's structured. And we explain it all in a little bit more detail when we work with clients. And then briefly, just to explain a concept of the investment accounts, there's 2 things that you'll set up with a self-managed super fund. You'll end up with what I call the downstairs and the upstairs. So if you think about opening a bank account, we all know that you go to the bank and you fill out lots of forms, sometimes online these days, and you'll end up with a bank account with a BSB and an account number. No different to a self-managed super fund. And that bank account is going to receive all the contributions, all of the rental income, all of the investments that come from the remaining cash that's invested. Any revenue that's coming into the SMSF is going to go into the bank account downstairs. And from that bank account, there's going to be expenses. There's going to be contribution tax, because the SMSF, like any other fund, you're required to pay 15% contribution tax, and there's also 15% earnings tax, the same as HESTA, the same as Host Plus, the same as SMSF. So the fund has revenue or income, it also has expenses, okay? And that all happens in the bank account downstairs. But importantly, it's upstairs that we're more excited about, which is really your strategy B, because your property's already sort of sitting over here, but it's that remaining 40 or 50 or $100,000, that's all going to be invested upstairs into a portfolio that we will work together with clients to build. Everybody's comfortable with that? Bank account, investments upstairs. Bank account downstairs, that's it. That's a self-managed super fund, right? Not quite. Very quickly, the process of setting up a self-managed super fund is quite extensive. And I typically try to express it this way: 9 steps in 9 weeks. The first 5 weeks are the important pieces, because it takes about 5 weeks to 6 weeks or so to put it together. It's the discovery, the modelling process, and the research process, and what we call the advice preparation or the advice construction. And that culminates in step 5 there in the middle of the screen, the presentation, the setup, and the implementation stage. And it's at that point when we can sit down with Sanders and say, Sanders, good news, we've got all the names of the entities in the Bear Trust. We know what we need to put onto a contract of sale now. So what am I saying in this process here, 9 steps over 9 weeks? I'm saying that because there is a lot of things that need to happen, you don't want to go and sort of start looking in the market and find a property and go, oh, I'm really excited. Can I speak to your financial planning guy, Sanders? And you ring me and say, we've got this property, we've got to exchange next week. Whoops. You don't want to be in a position where you want to exchange next week, because it's almost near impossible to put it together in a week. We might be able to put it together in 4 weeks if we're really lucky, but typically it's about 5, maybe even 6 weeks getting to the middle of the screen there. So the idea is that if you're interested in going down this process, there's a number of things that you really want to do. 1, you want to really make sure that you start thinking about the idea of SMSF. 2, start speaking with someone like myself as far as a financial planner so that you get good advice. We'll then make sure that you're talking with someone like Jeremy's team, because you want to make sure that we understand the numbers in the SMSF in terms of your borrowing capacity. And then, of course, from the middle of the screen there, after the setup of the SMSF, it's about setting up the ABN, the tax file number, the bank account, the investment accounts, making sure we notify your payroll, all those implementation pieces. We look at all your personal insurances, because we don't want to set you up in a self-managed super fund and then realise that we've left some insurances in your industry fund from before, because when that money rolls over, those insurances will cancel. So we actually make sure that we don't miss anything along the way. We roll over the funds. Sometimes we'll roll over most of the funds at the first point, and we'll leave a little bit in the industry fund while the insurances are being considered. And the final step is the rollover of the total amount. And then the SMSF is up and running, typically around 9 weeks or so. Very briefly, I don't want to labour on these points, but it would be unfair if I got up here and just said, self-managed super funds, they're fantastic, that you can do amazing things and everybody should do it. That's not quite the total part of the story. There is responsibilities that you need to be aware of. There is administration that you need to be aware of. So the very first thing is that when you become a director, trustee of your corporate company of the super fund, the legal obligation sits on your shoulders. Although we're running around behind you doing most of the work, we aren't legally responsible to the Australian Taxation Office if something goes wrong. The director trustee of the SMSF is. Now, as daunting as that may seem, the good news is we work with clients to make sure that we do all of the things that they need to know so that you don't miss a beat. So importantly, although there is a heavy responsibility, in the day-to-day, week-to-week, month-to-month operation of a self-managed super funds, our trustee members find that they don't really have to think about much, and if they do, our office will be advising them, and then everything's basically done. So yes, there's a heavy responsibility, but we work with clients, and that's part of what we do in our service. You have control, you've got more flexibility, we've already talked about that. And the onerous obligations, if you listen to the tax office and the government, they'll say running a self-managed super fund can be 3 to 4 hours a month of administration. Now for most of us, if somebody said, look, I've got this new job for you, I know you're running a busy family and you've got a busy job, but can you please do this for 4 hours each month? Most of us are going to say, well, I've barely got enough time as it is. I don't want to have to take half a day out of a weekend somewhere to run around with a self-managed super fund. When we take out most of the work there and we're running around and we're ticking all the boxes for you, we find that for most clients it ends up taking around 6 to 10 hours a year of work to run a self-managed super fund. So it really isn't so hard. It isn't that hard at all. But there is additional obligations that you need to be aware of. And I think that was what was touched on earlier was the sole purpose test. On the top right-hand side there is the one that I talk about more. Thinking like a trustee requires you to think a little bit differently. So the very quick example is this. I have clients that come to me and they say, Michael, I want to use my superannuation and I want to buy a property up on the entrance on the Central Coast. Beautiful part of the world, pelicans, over the water, sun rising every morning, because we want to retire there. That's going to be the place we want. The problem is that the government doesn't want you to think like that. The government wants you to think that when it comes to your superannuation, every decision that you make is about maximising the return of members' retirement savings. It's not about where you would like to retire. Now that doesn't mean necessarily that the decision is not the entrance, because the entrance, if Sanders and the MSISA team have done their homework and said, well, we think the growth prospects for that area are solid, and we think the rental return ticks the box, then the entrance may very well satisfy the sole purpose test. But it's not about where you like, and it's not about where you'd like to retire. It's about making a very, very almost corporate decision. Is this the right thing for the members' retirement savings? So it's different to your own money out of your own pocket. Government wants you to think that your own personal life is over here, your owner-occupied house, your cars, your investment properties, that sits here in this corner. And in this corner on the other side is your superannuation fund, your retirement savings. And the two of them are never really to cross or interfere or infect each other. In fact, what you do here if you borrow money to buy an investment property or get involved with an investment project with MSISA, that's not going to have any impact on what you do with your self-managed super fund. And if you borrow money in your self-managed super fund, people think, oh no, I'm a little bit worried about that because I was thinking of buying an investment property over here. Well, it may very well be with your capacity, you can do both. Because you're borrowing over there with a self-managed super fund doesn't actually impact on what happens over here in your personal life. So you've got to think about your personal life very separately to what happens in your superannuation fund. Everybody okay with that? And the good news, which I've sort of touched on briefly, is simply to say, from go to woe, we're there to do everything that has to be done for you. We don't pay every invoice of your SMSF, but we do pay some of them. So we'll work with a client, and because it's all new ground for them, we'll work with them, and once the monies have rolled over, they'll say, well, I've got to pay for the setup of the SMSF, and I've got to pay for the deposit on the investment property. Sometimes the clients have said to me, well, Michael, can you go in and push the buttons for us? Now, just to clarify, I can't go into your superannuation fund and say, oh, this is nice, let's take some of that money. Nothing can be done without your authority. So the example would be is that we'll go into your accounts and we'll push the buttons to do a transaction to pay a bill, and you will receive an SMS code to authorise that, and we would have spoken to you before that, and you'll send that 6-digit code back to us, and that gives authority to pay a certain bill. So there's lots and lots of things that we do. We check in on every SMSF every quarter. We look at every transaction that happens in the cash account downstairs, because we want to make sure that we are on top of everything that's going on to make sure that your fund is being managed properly and that it remains compliant with the ATO, and that when it comes to an audit at the end of the year, the auditor is going to just tick all the boxes to say, how well run is this SMSF? I think we're kind of at the end of it. Hope I haven't gone too much over time. Questions, guys?
So if we have a property which is out of a super and the property within a super comes taxation period, would I be seen as double dipping if, say, I'm making a hearing on my non-super property and I get a tax back from, ATO? What happens if I go negative gearing on my super property? Do I get also something back? Like, how does it work on
Melloroon, I would love to say to you that you're going to get extra money back in your pocket because of what you're doing in your SMSF as well, but you don't. So what goes on over there stays over there. If it's negatively geared, the benefit is that the fund has that opportunity to pay less contribution tax or investment tax. But it doesn't transfer back over to this side, to the personal side. And what happens here, if you've got an investment property out of pocket, that may be tax advantageous to you personally, but that's not going to impact on what happens over there. And unfortunately, even though it'd be lovely to think, well, wouldn't it be good to do some things inside super and just get some extra free money? But you're not going to, unfortunately, it doesn't cross over. Everything in SMSF stays over there, everything in your personal life stays over there.
But that one stays over there and cross over there.
So if you've got an investment property outside of out of pocket that you've organised to purchase from your income, the excess income that's not inside your super, that's not going to have any bearing on your SMSF.
What I'm saying is my savings, my personal savings account, I can put it more on super.
You can. You can. Correct.
The personal one can cross over.
Yeah, correct. So what I'm saying is that you can certainly add additional contributions to super, and that may be to your tax advantage to boost your retirement savings. But in a sense, other than sort of the contribution piece, I'm saying that the property that happens over there doesn't actually impact over here. Yeah? And it may or may not be, if we think back to what Jeremy was talking about with holding an offset account with your SMSF, there's different strategies that can operate. So some people will go, well, you know what, I'll buy an investment property and I'll make sure that there's an offset account that's attached to that so that I actually have the opportunity, if I'm paying extra, to build up that money in the offset account that I can then withdraw that. You can do that both in an offset account, but you can also do that simply by having the investments in the investment portfolio. So for example, if we build a portfolio in your SMSF and we have a percentage invested in shares, so your property's here and your investment portfolio's here, we might be able to find a way to see a 7, 8, 9, 10% return on your cash investments in the SMSF. And it may, depending on your timeline, it may be more advantageous to have that money in an investment account and not in an offset account. Depends on your timeline and your personal circumstances. So some of those sorts of detailed conversations I'd need to talk about with people personally. So, yeah? But paying extra contributions, absolutely. You can pay extra. The question as to whether you pay extra with the primary motive to pay the mortgage down sooner in your SMSF, again, it's a personal financial advice question, because I tend to say to people, well, is your primary motive to really pay more than the basic principal and interest inside the SMSF? Maybe what you really need to do is to keep a little bit in your pocket here so that you can buy an investment property out of pocket as well. So it's a bit of it's a balance, and it's going to be individual by individual financial planning needs.
So is there a limit how much you can put into the super fund or SMSF? Is that a property value wise?
There is a limit as to how much you can pay into super. They have what they call a contribution cap. The contribution cap at the moment is just about to move on the 1st of July from $25,000 per year to $27,500, I think. And when I say $27,500, I'm not just talking about the cap as to how much you can pay that's deductible, that's tax deductible. It includes the employer's superannuation guarantee contribution. So if you're earning $100,000 a year, for example, and your employer's paying 10%, to use a simple example, on July 1 under the 10% rule, we know that $10,000 is already going into super, so therefore there would be an excess of $17,500 that you could pay additionally into super that would be tax deductible. And for some people, depending on where they're at in the stage of life and what they're wanting to achieve, that can be, from a tax perspective, very advantageous. So that's the first cap. The second cap is what they call your non-concessional cap. Stupid words the government uses, unfortunately, but it means that the first amount is tax deductible. Anything over and above the $27,500, up to it's another $110,000 a year. You can add $110,000 per year on top of the $27,500 from the 1st of July, but it's from after-tax savings. So in other words, it's money out of your own investments or your own bank account where you've already paid tax to earn that money. You can add that to your super. And some people would say, well, why would I do that? Well, the reasons, it'll be, again, individual by individual, but if people want to boost their superannuation savings, or if they haven't quite got $200,000, there may be a reason to pay more than the $27,500. And just to then go back to the $27,500, if you haven't been paying extra contributions for the last 3 or 4 years, the government lets you top up the tax deductible amount. So we've got some clients we're working with at the moment who have got that scope to do $27,500 next year, but on top of that, the extra 17.5 because they haven't been paying extra, in some cases more because it was 9.5%, they've got that scope to pay possibly $40, $50, $60 or $70,000 and have that fully tax deductible. So if somebody's had a really, really good year and they've been working double shifts down at the Norwest Hospital, those opportunities might be real. So people should be talking to me. What, did I say something? All right. Any other questions?
Yeah, just quick. No, I'm not the property value, but it's the limit of property value you can hold in this SMSF? Like, 1 million, 2 million, 5 million, is there a limit?
There's a limit that as the maximum that you can hold in super when you get to pension drawdown age, which currently sits at, it's just being indexed to 1.7 million. Yeah, so you've got to remember though, that if you buy a property for $575,000 and you've got $100,000 left over, that's not $675,000 combined because you've also got the loan that comes off. So it's actually your account balance. So when the accounting and auditing is done on the SMSF and your member super statement's done, your member super statement will be $675,000 combined minus the mortgage, and then probably divided by the 2 members. So one member may have come to the fund with $150,000 and the other members come with $100,000, and they'll have their respective accounts and the growth on those accounts, and that'll be split proportionately according to those 2 members. Hope I haven't confused you with that. Yeah.
Maximum 1.7.
1.7, yeah.
Is that the purchase or the capital gain as well?
It-
Purchase price of the property or is it capital?
No, it's your account balance, not the value of the property itself. Yeah, yeah.
So if you, what are these?
I'll come back. And sorry, Sandra, you can cut me off when we need to time out.
Yeah, I've got a question. You said 4 people can join hands to start a self-managed super fund.
Mm-hmm.
Are those people supposed to be only related or even friends?
That's a really good question. The answer is this: they want to be in love. And I don't mean a relationship. I just mean they want to really like each other. Because if you don't really like each other, you're not going to do it to start with. But you really want to make sure that you have good reason to come together. So husband-wife, other relationships that aren't husband-wife in the modern world that's allowable now, that's fine. If they love each other, that's fine. I have parents with children, that's okay. Different strategies to understand for those different members. I have siblings. I've got 2 brothers in one case. I've got 2 best friends as a client as well, and they just happen to be from the same community, and they're very, very close. And I've said to them, "Is there any reason why you 2 are going to dispute?" And I go through some of those questions, and they think, "Did I come to counselling?" And that's really the answer. Like, yes, you can. And the other thing to answer from before, of course, is that can you unwind an SMSF if things go wrong? Unfortunately, sometimes it happens. So there's a thing that sadly in life, there's a thing called divorce, and it does happen in reality, and yes, you can unwind, but it means selling the investment property, paying the 10% capital gains, having the final accounts of the SMSF done, and then taking the money potentially back to a public offer fund, like an industry fund or a retail fund. So you're going to pay about $3,000 on the roundabout on the way out, but that's just to wind up the fund. There's other costs of selling the property and so on and so on. So you don't want to start this thing unless you're very serious about the people that you're working with to do the SMSF. Please.
But is that still the same challenge when the 2 partners, one of the 2 partners reaches retirement age and the other one is still younger? So somebody needs to start eating the money. So.
That's a real. Have we got any special awards for the good questions? Like I should have brought chocolates, right? The answer is that you don't need to be fearful about one person reaching retirement and the other person being 5 or 6 years behind or 10 years behind. You can have somebody, because you've got to remember superannuation is about accumulation, right? Growing your superannuation, right? And of course, ultimately, when one person retires, they're not going to be accumulating anymore. They're going to be drawing down, aren't they? Okay? Well, that's fine. In an SMSF, you could have one member that retires and starts drawing their private pension from the SMSF while the other member is still accumulating. And it all depends on what you do with the property at that point in time. Sometimes if the liquidity of the fund is adequate, you may not need to sell the property straight away. And so it just depends. Sometimes people will keep the property for the first 4 or 5 years of retirement because the property's going gangbusters. And nobody wants to sell when the market's going gangbusters, right? So you may even retire and the liquidity of the fund may be adequate for both members to start drawing down and for the property to still be held for a year or 2 or up to as long as you like. And of course, if you sell the property and you're in retirement drawdown phase, no capital gains tax. Nice little sweet finish. I'll come back here first and then I'll come to you and we might have to wrap up, right?
Just can you clarify to me, what's the real difference between buying a property in SMS versus a family trust? You've got a family trust as well. What do we, if you have an opportunity to buy in either, so why would you buy in SMSF?
Okay, so let me answer that this way, Atula. My expertise in financial planning is superannuation, SMSF, personal protection strategies. I'm not an expert around family trusts and what all the tax advantages that exist there. If I could talk about just quickly the advantages of an SMSF investment as opposed to outside of pocket, I would simply say they are completely different and you should not try and infect the two. So I get these people, these prospects that come to me saying, oh, I've got 2 investment properties and I want to buy another, I just want to keep building my property portfolio. Again, thinking like a person, like an individual, it may very well be appropriate for them as an SMSF to buy an investment property, but it's a decision that should be really quite separate to their personal life in owning investment properties out of here. Okay? In simple, if somebody said to me, what's the best tax advantage? Well, you've got to remember that for most of us, if we're earning, say, up to $120,000, we're paying 32.5 cents tax on the dollar plus Medicare, right? For anything over 45,000, I think it is. So we're paying 34.5 cents tax on the dollar up to $120,000. And so if you're buying a property outside of super and it happens to be negatively geared, the tax advantage at 34.5 cents is better for you, right? But again, it's a separate argument. Inside super, it's only a 15% contribution tax and investment tax arena. So any negatively gearing is only at the 15% rate, not at the personal rate. So you just can't get confused between the two. But if somebody comes to me, possibly if Jeremy might have said, oh, I've got a client that I'd like to talk to you, Michael. I'm thinking about buying an investment property. Should I do it out of pocket or should I do it out of super? I would say to them first, is it going to be negatively geared? And if they say, yes, it is, in the first few years, I'd say, well, look, maybe just to start with, talk to Jeremy and the team about doing that privately. And let's not do financial advice because I don't want to charge you a fee. Yeah, but there's no reason why they can't also consider the SMSF if all their numbers make sense there, but it's not the equation. Everything's separate to this, over there, to what's over there. Final question, maybe?
What's the establishment fees and ongoing fees?
Oh, I was hoping nobody'd ask that question. I'd address that personally, but it's a 35-hour transaction to put together an SMSF. It's the most extensive thing we do. For a lot of clients, there's around about 7 to 8 strategies involved. I would simply say, to be fully transparent, that it's going to cost $7,370, including GST, for the setup of those 4 entities that I illustrated on the screen, and all of our services as a financial advisor to go through the 9 steps. Very extensive, very high value, not much money at all. But I don't say that lightly. It's an amount of money for a professional service, and it's a one-off cost up front that comes out of the SMSF once it's established that can't be ignored. You do need to consider, is it appropriate for me to pay $7,370 to go through this process? And the ongoing fees, to even ask the next question that you may not have asked, the ongoing fees for most people, if you've got a smaller balance of, say, $230,000 or $240,000, it's probably going to be lower cost running that out of your existing funds if you're focused on fees. But all I would say to people is, you know what? Sometimes if you want to make more money, you need to actually invest and invest money into a structure. And Sanders will talk about this with you, is that the people that don't buy these investment properties or don't get involved in these joint ventures, well, they don't make any money because they don't make a decision to step forward. And so the whole idea is that I can help clients understand if this is going to make money for your retirement savings and whether it's in your best interest. Thank you. I appreciate your time.
Thanks, Michael. That was very insightful. I'm here from another one of our clients, Temple. So Vusa's story is a little bit different. So this is actually a property that he acquired himself, but he didn't actually quite realise the value and the potential that this property had. So Vusa, if you could please just come up, please. If you could just let us know how you met Sanders, how your journey has been thus far. That'd be great.
Thank you so much.
Pleasure.
Thank you. And I put the microphone in there.
Yep.
Give me a sec.
Maybe just...
Yeah, it's right. Perfect.
Good evening. My name is Vusi, as I've been introduced. I actually met Sanders quite a while, just like probably everyone here who knows some Sanders as part of our Zimbabwean community. But from a business or property sense, I guess in the past 5 years or so, when he basically established MSISA consulting agents. So at the time when I met him, in fact, at the time when we started talking about, my current strategy and a few things that needed to change, because obviously at some stage you realize that you're not progressing with the amount of, in fact, with your portfolio that may not be quite in the right setup or in the right strategy, or your strategy might not be clear enough. But through his experience, once I engaged him, we sort of talked much in detail, discussed a few things, discussed ways in which we could sort of approach our portfolio, I and my wife. So this property, we sort of had it for a while. It was sort of like a comfortable, because it wasn't negatively geared, it was just sitting there. And we thought, let's just keep it, maybe prices will go up. What ended up happening is that through discussions with him, we realized that we're actually sitting on a gold mine, because it's actually sitting on a almost 900 square meter block. And we sort of didn't realize that you could actually split it up in a way where it could actually make you money. So what we've done in terms of where we are now, we've gone for DA approval with Wollongong Council, and the approval is about to be issued. And the projection is that, once everything is done, we'll have 2 separate units, 3 bedrooms each, double garages, and it's gonna make actually a good sort of outcome once everything comes out. The finances were pretty good, considering that we'd acquired this property a while back. So it presented in such a manner that we could, basically go through it. We were assisted by Jeremy sitting here. And as we stand, we sort of just are waiting to start within a few weeks. Any questions roughly? Or it's just a simple, straightforward, easygoing, not easygoing as such to us.
So are you demolishing everything?
Yes, this is going to be demolished. And yeah.
So obviously you added the cost of demolishing and redoing from the start, offsetting.
Yeah. Well, once we discussed through, our meetings with Sanders and Jeremy, all those costs are well catered for and allows for everything to be done, and also the outcome being good enough to really see the effort that you put into it.
You'll be making a 20% margin, right? A profit margin?
Over. Yeah, well over. So I guess for me, the value was getting to sit down with him and, just unlocking a few areas that I think, because he's dedicated in his work. I work Monday to Friday, 8 to 5. Sometimes you don't get to think a lot about, some of the things that you have, or even just to research, it becomes difficult. You can't even research at work or do any of this stuff, but he's got all the time. So I found it better to just say, hey man, you work on this all the time. What can we do? And we've been having sessions and they've been really, really valuable. So yeah, that's where we are in regards to this one, unless if you want to add something onto it.
Are you keeping it or you're selling it?
There are options of keeping it, but with the way we have discussed our strategy, of which I am agreeable to, we are looking at disposing all of them because it's a journey. It's only the first step, and the next step, more or less similar.
Yeah, look, the only thing I can actually add on this type of deals is that for me, it's not something that I am actually emotional about. For me, it's just about numbers. If it doesn't work, it doesn't work. If it does work, then it actually does work. There's no point holding such a very old house that has actually, you can see it has had its own days. So we need to look at a way we can maximize, if you spend $1 on this, make sure you get $3 out of it. That's how I actually look at things. So this is a very, very, very good deal that will bring this family from this situation to a better financial situation and be able to do better deals. Congratulations for that.
Thank you very much. If there are no questions, thanks.
Thank you, Vusa. It's actually not very surprising. Things like this, you might think they're quite rare, but it's one of those things that you don't know what you're looking for, but these things are always out there. Okay, so now we're going to hear from the final presenter. So Sanders Muleya, an immigrant, moved to Australia from Zimbabwe and has managed to grow his property portfolio and has really managed to do a lot of amazing things in property investment. Thank you.
Thank you very much, guys, for coming here. Today is not about me. Today is about you all, guys. You have taken a very, very big step. Today is a Sunday when you're supposed to be having your families or, going to church or doing all those things. But you have taken this day out of all that stress to actually be able to attend. So property investing is one of those things that is about continuous education. The reason why we called you as a VIPs is to, to continuously learn. We want you to move with us in this journey. We want you to prosper with us every day. For me, I am like a sponge. I continuously learn. There's no limit in education. The only time I'll stop learning is when I die. So today I am going to show you some of the stuff that we do and some of the stuff that our clients actually do. So please, I want you to be engaged. You should be proud of yourselves, okay? And please, to learn, you need to ask lots and lots of questions. Some of the deals that we are going to see are some of the deals that our clients have actually done. Sorry, I may not have asked for your permission to do that, but I think you should be proud about this, okay? So again, thanks to Jeremy and Michael for having this possible. And I can't thank you enough again for you being able to actually attend this. So it's very hard for me to talk about my story. My story is very long. If you want to learn more about myself, you can go to my website. Everything is actually there. I've got two websites. I've got a personal website and I've got a business website as well. As we go through the slides, you actually get to know that. It's very, very inspirational. It's some of those things that are very hard. And then people will say, well, how did you manage to do this? So I like to inspire people and I like other people to also progress and maybe one day be like me. So this heading there that says from an immigrant nest to financial freedom through property investing. There's a book that I'm writing, and that is the topic of the book, and that book will be out very soon. That book is there to actually educate people that want to invest, but they've got problems. They don't know where to start. They can't find the right information. So as you can see there, there's my family on my right. That is my family that has been inspiring me all along. And that's why I am doing this. I am doing that for my family. And then on the left there, you know, people will be asking, what is that all about? So when I see such things, this is one of my achievements. So I was voted the second best investor in the entire Australia. So there were 600 attendants there, and they had to vote for the best 15. So I was in the last 15, and surprisingly, I became second. I couldn't believe it. I nearly collapsed. And what actually came about that is I had to tell my story, how I started investing and how I am actually impacting the community. I'm actually involving my children as well. And as you are aware, I am actually helping other investors as well. You know, each day we are getting older and older. Sometimes when we have a nice life, you drive a nice car, you live in a nice home, you never think about retirement. We never think that one day we are going to stop working. But no matter how strong you are, this is the right time to actually start now and plan your life. If you start planning about your life when you are already in your 50s or 60s, it actually might be too late. So for me, I looked at a number of investment strategies, but somehow I am comfortable with property because this is what I've been doing my entire life. I am very, very, very passionate about property. And when I say I am passionate, that is an understatement. You know, I sleep property. Every day I research property. Everywhere I go. Like if you meet me and you want to talk about anything, I'm telling you, we will spend the whole day talking about property because that is what I love. So there are reasons why I chose to invest in property. The first thing I realized is once you buy a property, it is made out of bricks. It's something that stands there. I can see it. I can feel it, right? And the good thing is it has got a return on investment, meaning that I'll buy it, I'll put someone in there, they'll help me pay the mortgage, and most of the time, the outgoings or the costs will be actually paid for if I buy well. So to me, that's a very, very, very secure investment. Of course, I need to come up with my own money to initially buy it, but once I buy it, I don't need to worry anymore. So there's, as you heard from Jeremy, there's a lot of finance options. Banks are now scrambling for your money. They can actually borrow, they can give you money to go and invest in properties. So that's one of the assets that is actually very, 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 very good because the banks can lend you money. I don't know what happened to my clicker there. You want to, okay. So it takes benefits. So the ATO, for you just owning that investment property, there is a lot of tax benefits. whatever expenses you actually incur during that period, be it, you can name it, be it insurance, be it the interest rates you are paying on the loan, at the end of the financial year, you can actually get that tax back. Although you don't get the majority of it, but the ATO will actually give you some of that money for owning that investment. Security. Property is one of those secure assets that whenever you buy, they're not like shares. I know maybe I don't have much knowledge about shares, but shares are always fluctuating. There's a lot of risk. Once something happens, the market can just go down anytime. But property is quite a secure investment. Capital growth. I've been investing for almost 13 years now, and properties just go up like crazy. I'll show you some of the examples. So that's why we invest in properties, for that capital growth. I've gone too far. Sandra, can you fix this? Right, I was talking about retirement. We are working so hard for all these years, and then you reach retirement age, you can't even tell why you were working. So for me, if I buy investment properties, they are, as I said, it's a secure investment. There will be money sitting there. Like, my strategy is to buy as many as I can, and then at the end, maybe if, say I've got 10, I can sell the other 5 and maybe leave the other 5 debt-free. So if I leave the other 5 debt-free, meaning that all the rent that is coming from there, I don't need to think about working. I can actually retire comfortably. Or even if my finances are not okay, I can just sell one of those and be financially independent. Because bills will never stop. The older you get, the more expenses. You have maybe you have got some medical issues to deal with. You still have to, if you are still driving, you still need to maintain your car. So where do you get the money from if you are no longer working? So this is why I am using property as a way of security when I get to retirement. So I will never really touch much on this. This has already been touched on, how you can actually start investing. There's a number of ways. So one of them is the traditional way, where you need to come up with some savings. So you need to be a very good saver, save enough money to be able to buy an investment property. The other one is equity has been touched on. Self-managed super funds is a very good one. And positive gearing. When I started investing, I didn't understand really the difference between positive gearing and negative gearing. But once I understood what the difference was, I never looked back. So anything that has got the word "and" at the beginning, I don't look at it. I just concentrate on positive gearing. So positive gearing is when you buy an asset that whatever rent comes in is enough to pay for everything. That way, there's more money coming in, I can concentrate on actually accumulating more and more assets. Whereas negative gearing is when you buy a property that the rent is not enough, it doesn't cover enough. That's where you need to look for a second job to actually pay more. So you are limited in what you can actually do. If you are lucky, you may buy one or buy 2, and then that's it. But if you are positive gearing, you can keep on going. And then joint ventures, there's some deals there where 2 people, 3 people can come together, put some money together and be able to invest. Right. So obviously, you know, investing comes with its own rewards. What I would recommend you guys is, there's a stage in your life where you accomplish something very big. This is the time to celebrate. And when you celebrate, you're actually telling your brain that this is good. And if you do that, the chances of you doing it again is very high. So I'm showing you this picture here because it was after I had achieved something that I didn't think I was going to achieve. So to reward myself, I had to jump on this. So this is not mine, okay? Yeah, sometimes we work so hard, but we don't reward ourselves. So somehow, it doesn't have to be big like that. It could be just going for a movie, or, you know, taking your family for a holiday or anything like that. You know, that way, that's the only way you can actually celebrate. And we live in a very lucky country. I don't know if you are aware of that. You know, there's been so many problems that has been happening around the world, let alone in Australia. We have had droughts, we have had floods, we have had, you know, COVID-19 of late that is still ravaging the entire world. We had the GFC of 2008, but somehow Australia still stands. I don't know if you have actually realized that. No matter what happens, the Australian economy is always bullish. So this is the country to actually invest. So many countries actually envy Australia. A lot of people want to invest, they want to put their money in here. So that's why I am secure with all my investments, because I know this is a very, very, very stable economy. So the other thing that makes me invest in property is having that freedom. You know, sometimes we are so tied up, we can't do anything. We are limited on finance, we can't go for holidays, you can't even enjoy life. But as you realize, as you grow, as you accumulate these assets, you realize that at the end of the day, you have got freedom to do anything that you like. I've got choices, which is the same. You know, best education. So we all want to send our kids to school. We all want our children to have the best education. You know, if you have got extra money, if you have got extra cash, this is how we can actually achieve this. And after all, we all need best health care. So, you know, people always say that money is the root of all evil. To me, it's quite the opposite. If you abuse anything in life, it's likely to be like that. If you abuse food, if you eat too much food, you know what will happen on that. So money is here to actually make us better. Anything you can think of today, you drove to get to here because of money. Whatever you do in life is all about money. We all have got jobs because of money. So I don't know how that word comes to say money is the root of all evil. When I hear someone saying that word, it's a sign that they want the money, but they don't have it. Right, so now I'm going to get into some of our client deals. So MSISA Property and Consulting has been operational under 2 years, almost 2 years, but we have achieved so much. I can't even believe, and every day so many things are actually happening around us. When COVID-19 hit, I spoke to a number of my clients. I said, guys, this is the time to get into the property market. The majority of them were saying, why do you want us to get into the property market with all these uncertainties? But I tell you, for myself, I invest so much when there's a problem, because this is the only way I can get out and get what I want. So there were so many properties on the market, no one was buying them. We could negotiate, and we went and purchased a lot of them. 6 months down the track, or 8 or 12 months later, look at what has happened into the market right now. The property market has just gone berserk. So we use a lot of knowledge, we use a lot of research, a lot of experience and expertise. We don't just buy stuff, we buy what we want and we leave what we don't want. So this is one of the investments that was purchased with one of our clients. The purchase price is $420, the rental return is $420, and this was bought last year. It's actually under 6 months, and just look at the value right now. Where else would you make that money in 6 months? And we don't know what will happen. I'm not saying that that is certain, but these are some of the results that you actually get. This property here, the reason why we bought it, I don't know if you can see very well, that property is made of 2 levels. It's the underneath and the top, and is actually self-contained. So you can rent at the bottom and you can also rent at the top. The purchase price is not great, it's $340, and the rental return is $520. It's almost 7% return on a residential property, and the value is $308 already. This was purchased last year as well. And the good thing is there's also land at the back to build another house in the future. So this client, we're actually helping them to get everything underway so they can build another property and then increase on the rent, increase on the value. Surprisingly, my wife likes to take photos everywhere. So she ended up getting caught in that photo there. So that's one of our clients again. You know, this is a duplex that was purchased last year. They bought it for $550, and I just checked in the market right now. It's already $620. Similar stuff is selling for $620 in that area. So guys, this is quite nice stuff. So if you look at the values that we are purchasing these properties, we are not using millions of dollars. You know, everything is nearly under 600, 700. If we buy for something for $1 million, there's a reason. We have to actually justify it. So this is one of our clients again. They bought this for $585. That was last year as well. And properties in that area are selling for, I just checked yesterday, they are selling for $680. So that figure there is already out of character. So, you know, this is why I love investing in properties. Right, this one is $1 million purchase. So the justification for that is because there are 2 properties together. So that is a duplex, and each of those, the combined rent is, so each is renting for $530, and the combined rent is $1,060. So that's why we spent $1 million on that one. So the advantage again there is, even if the other one is not rented, at least you can still collect rent from the other one. Right, this one is just to show you how properties can actually, you can generate a lot of equity out of them. So this property was purchased in 2015. It was purchased for 650. The rental return is 750. So if you look at the rent, the rent is always more than the purchase price. And the current value is 1.2. So, 2015 and now we are talking about 5-6 years. So, yeah, I don't know where else you can go in this world to do that. And these are real deals. Right, as you saw now, we are actually stepping up. We're getting clients that want to build. So it's not only just purchasing investment properties, we also get into construction. So this client is a duplex build. Their aim is to continuously invest. So the plan is to buy a property every year for the next 10 years. So this is a duplex build. There's a duplex being built there. They'll sell one and keep one. So whatever money they injected into the project, they'll get everything back, probably a profit of 100K on top of that. And then their debt will be 460, but the rental return on that property is 580. So this is the only way you can continuously accumulate stuff. So again, we find the land, we manage everything from start to finish. This one is a joint venture deal. It's a more complex stuff. It's a 6 townhouse development. I don't know if you can see very well there. It's a 18 months project. So it's a bigger project, long time frames. But if you walk away with 600K profit in 18 months, I don't know how long it takes you to save 100K. So guys, I am really fascinated with this, and that's why I called all of you to come down, sit together, share stuff on that you can actually see by yourselves, things that can be done by other people. Not only that, things that you have done yourself. There are so many deals, I can't fit them in there. I don't even have time to talk about them. I've been only given 20 minutes to do that. And somehow I've actually compressed it. So some have been asking how MSISA Property and Consulting work. The first point of call is to maybe make an appointment. We sit down with you, we review your current strategies, look at the short-term goals that you have, the long-term goals that we have. We then plan together. Sometimes people say we don't have money to invest. Somehow after sitting down, you realize you've got a chunk of money sitting somewhere. And then we actually plan together. So it's like the majority of our clients are in the nursing field. They are very busy, they are super busy. They have no time to research, they want to invest, but they don't have time. So this is the only time you can actually leverage other people to actually help you. There's a saying in life that it's either you do nothing, secondly, it's either you do it yourself, or thirdly, you get someone to do it for yourself. But it's not only someone, it should be someone that actually experienced in what they do. And the other saying is, it's either you walk, or you run, or you fly. So which one would you rather choose? If you walk, the chances are that you get there, but you take a hell lot of a time. If you run, the chances of tripping are very high. You may not get where you want. If you fly, it won't take time. You have to drive to the airport though. So we then help you, and then we find the right investment for you. And not only that, we go, if it's an investment property, we go as far as making sure it is actually rented. That's the only time we actually walk away. It doesn't end there. You become a family like we are here today. Down the track, you have got a problem, you can still contact and say, look, I've hit a snag here. What am I supposed to do? So it's not like it's just a once-off service and then you are actually forgotten. Some people have bought 1, 2, 3, 4 properties. We've got a client who bought 4 properties in 1 year. That's very crazy. So today I thought about, you know, we need to reward each other for whatever we do, and we need to motivate each other. So the first motivation is continuous learning, which we are already doing. So we are going to be holding seminars. It could be Zoom, it could be, you know, face-to-face as we are doing right now. But guys, I encourage you to educate yourself all the time. Do not think that by buying an investment property you are okay. You need to continuously learn. And the other advice is, don't be scared of talking of these things. I know you don't have to be telling everyone, but the more you talk about it to friends and family, you get that joy, you get that drive. That's how we actually continuously prosper. So we are in this together, and we need to actually prosper together. So step number 1, I am actually rewarding everyone and each of you if we are requesting for referrals from you. So if you've got a family member, a friend, or anyone that you know that they are stuck, they want to invest, but somehow they can't do it. So you can actually refer them to us. It's like a preacher trying to preach to people. Not everyone is going to repent, but somehow 1 or 2 people will say yes. Right. So if you refer a friend or a family, we offer you $250,000 for doing that. So this person would have gone through, then they've purchased a property with us. We offer you $250 for that. Yeah. Sorry. Did I say 250,000? Sorry. No. I'm trying to say $250. Sorry, guys. If you refer a friend or family member, we offer you $250. And if you refer another person, you are given $500. Okay, $500. And if yourself you have purchased a property already with us and you are coming for the second time, we give you a 10% discount. So this is a journey that we want to go together, okay? And it doesn't end here. I don't want you to buy one property and then think that's the end of it. I don't know if I didn't tell you about my story. I ended up with 15 properties myself. That's where I am aiming you to be. At least 10. If you can't make 15, at least make 10. Okay? It's something that is very, very achievable. But somehow, when you tell yourself, I can't, you constantly tell yourself, I can't, the result will be, I can't. But if you constantly tell yourself that you can, the result will be, you can. And the good thing is I've made so many mistakes, so many blunders. I've fallen and risen. But you guys are lucky that you've got someone that you know, someone who can actually help you. And this will actually speed the entire process. If you don't want to spend money, well, nothing will happen. Somehow we spend money to get somewhere. And we need to help each other. Let's not keep quiet. We need to help each other. We need to grow as a family. So this is all that is about the MSISA Royalty Referral Program. So, guys, I'll thank you very much for coming here. And do not walk away. If you're gonna go, please say, I am going, because there will be presents given. This is just a thank you to say you have done it. So if you can all stand up and get a high five. Can you stand up, guys? Be proud of yourself. High five. Right, so then, guys, if you want, before you come to the questions, if you want my contact details, those are my contact details there. As I said, it's either you can contact us directly through the mobile number or email, or you can get to the website. Join the Facebook page. There's a nice Facebook page there as well. This is just for like-minded investors. It's not just a simple Facebook page. And as I said, please watch for these type of events. They'll be coming through now and again. Continuously learn. And to help MSISA Consulting as well, if I could get some of those people that are free, as I said, just be free to give a video testimonial about your achievements. You have seen Dr. Atula here. He has said it vividly about, he has said everything in his own words. The same happened to Vusa. He actually did that the same way. So at the back of the room there, there's a videographer sitting there. All you have to do is in 2 minutes or less, just say, if you have been assisted by MSISA Property, how you felt about MSISA Property. That will help us grow. I don't know, Sandra, if you have got anything else to say. Yeah, sorry, a question. You can sit down, guys. Sorry. You can sit down. It's question time now. Or the duplex deal, yeah?
Yes. So are you able to do it in the self-managed super fund?
No, you cannot build in a self-managed super fund.
Okay.
It has to be a single contract deal. Yeah, you cannot construct. Yes.
This is for Michael. I was just trying to follow the new budget announcements. There's an issue about, reducing the size of your home when you're retired.
Yes.
And when you sell it, what do you think? You put money into the super fund?
So the answer to the question is, if you are going to sell a house in retirement, let's say, for example, the house is worth $1 million. Well, we've got to talk about $1.5 million in Sydney, right? And let's again use the example of husband and wife. There is actually this scope for you to use a maximum of $300,000 each from that sale to put into the superannuation environment. So therefore, it's an opportunity to boost your super. Yeah. But there's rules around it. You've got to have lived in the property for 10 years, I think. There's a whole bunch of rules around it. It's not as simple as everyone that lives in a house who sells at that age. The budget announcement was actually an extension, I think, of the age group. I think they brought it back down to 60, whereas before I think you used to have to be above the age of 65. So the advantage now with the budget is you only have to be, I think, 60. Don't take that as a quote. Check with me if you want to get some specific details there. But there is, yes, an opportunity to, effectively, it's designed for downsizers, people who are in a big house, all the kids have left home, and you're now 60 years old and you go, oh, Mary, what are we going to do with the house? Sell the big 5-bedroom house, move into a 2 or 3 bedroom house or an apartment, and some of the profits you can put back into your superannuation, give yourself that boost.
Yeah, any other question, guys? Yes?
I'm sorry, but I'm not sure whether the question was asked. I didn't get what they asked. But it's about the interest rate on a self-managed super fund property. Is it possible to refinance that?
So Jeremy, that's your question there.
Thank you. Yeah, answer is yes. So you can refinance a SMSF investment loan. You cannot refinance and increase the loan amount. It has to be dollar for dollar based on the existing balance plus some of the costs to refinance. But the short answer to your question is yes, you can refinance an SMSF loan. And the reason why you would do that is because if interest rates have fallen, which it has over the last 6 months, there now is an opportunity for clients to review the SMSF loans. If you've had SMSF loans for more than 3+ years, some of the major bank lenders like Westpac and St. George, they were previously writing SMSF loans, but they've sort of slowed down that market. So there's only a handful of lenders that can still offer SMSF loans. And it's a good time to review your rate and your product to see if it's still suitable. And if there's a better opportunity out there to get a lower rate, then as long as the sort of fund will benefit from the refinance, yeah, most definitely you can refinance.
So thanks very much for your questions. So this is continuous learning. We encourage this, and the more questions you ask, the more knowledgeable obviously you become. Yes, please.
I've got a question in regards to development that that is doing. There were 5 townhouses there. Yeah. So does it mean the approach is applying for getting a constructing loan, or that could be approached as a residential loan?
So do you want me to answer that? Or? So there's 2 types of loans. So there's residential or commercial. So sometimes you can build up to 4 dwellings. That could be still residential, but normally 4+ becomes a commercial finance. I don't know if I've answered your question.
Yeah, it does. So which means whatever you have to put forward, obviously since it's a commercial, it's probably higher than usual, 20%, 10%.
Yeah, the lending is totally different. Yeah. Right, guys, if there are no more questions, please, as I said, if you're free to give testimonials at the back, that would be really very handy. Sebastian, you ready? Okay. So just feel free.
We just need to, for people listening, to bear some legalities.
Okay.